one of my favorite deals. A mentee of mine, he didn't have loads of money. We started to pair up properties. Instead of doing the whole transaction together, we split the transactions up. And also he had separate contracts on the different deals.
Which was the key, because when initially he came to you, he was looking at one contract for all 8 properties.
That's right.
You said, hold your horses here. You haven't got enough cash for that.
Welcome to the Property Business Accelerator podcast. And I'm here today with my broker, Bruce Mainwaring from Bond Finance. Now, he's been working with me for a number of years, so long I can't actually remember. But he does loads of business in this space and is one of the best brokers in town. So, Bruce, can you just briefly introduce yourself?
No, thank you. What a lovely introduction. Thank you, Mike. I started Bond back in 2004 now, so 20 years. With my business partner, Dan Newbury. We're FCA regulated. We're founding members of the NACFB. All my brokers are CMAP qualified. And I split my company into 2. I've got a Resi and buy-to-let arm, which only does Resi and buy-to-let, strangely enough. And we've also got a commercial arm. And the commercial arm does refurbs, ground-up developments, office developments, everything which doesn't fit into the more vanilla space. We're based at 50 Gresham Street, which is next door to Bank of England. And there's about 10, 11 of us. And yeah, we're exceptionally busy company right now, exceptionally busy. Rates seem to be slowly coming down. I really wish they were coming down a bit more. But yeah, it's people seem to be hungry. I think they've done nothing for 2 years. And now they're gone, they've got itchy fingers. Yeah, and we just seem to be submitting loads and loads of cases currently right now.
So you're doing lots of cases, and we're now sitting here at the end of 2024. And what kind of trends are you seeing, and what do you think the opportunities are then in 2025? So if you are sitting here planning next year as a property investor, you often see trends probably before other people because you're doing so much business.
Yep.
And you can see what people are doing well at and what they're not doing so well at, maybe.
Yeah.
Where do you think the opportunities are in 2025?
Right, let's spin it around, and let's talk about swap rates. Okay. The swap rates are crushing the buy-to-let market. Investors in the southeast are struggling to get 75% loan to value because the yields aren't there.
So this is the acute problem is probably London, where it's capital value is so high, and yields are therefore very low. And despite rental increases, it's just not working.
It's not, because we're getting a 3 to 4% yield on a property, and the swap money is 4%. And then you put the lender's margin on top of that, it's going to fail the rental straight.
Yeah, so the swap rate is what the banks kind of exchange money at, and then mortgage rates are a little bit higher than that, just so people know and understand what swap rate is. Is that a good way of describing it?
Spot on. So a bank goes and buys $500,000, and then they chop it up into smaller sections, put a little margin on, and then send it out to the retail market.
Yeah.
Now, and people forget, if the Bank of England goes down, it won't automatically mean the swap rate will go down. And the banks have to use up the money they've already bought before the new pricing comes in. So what you're going to find is that even though Bank of England goes down, it's only the lenders which are lending their own money, their rates move quicker. And that's the big 4 high street. So the retail-y type lenders who are doing residential mortgages, they move a lot quicker.
Yeah.
Then it's the sort of medium-sized buy-to-lets, then move, and then right at the end, the commercial lenders then move. So
you call them the challenger banks.
Challenger banks, yeah. Shawbrooks, the Lencos, the HTVs,
and this is the area that sort of you and I kind of operate most in.
Yes.
Because the bigger deals, the more complex deals, the semi-commercial deals, the commercial HMO deals, all have to go to those types of lenders.
If you want to recycle as much as your money back out, and so you can go again.
Yeah.
It's all about going again and going again, using the same amount of money as many times as you can.
Yeah.
Many times you can. Just like, what's your favorite deal?
So, yeah. So my favorite deal is, so we work together on deals because we often have clients in common.
Yes.
And what happens with us, isn't it, that we kind of come together. I do sort of my advisory side. I kind of structure some deals and then I bounce it off of you and you say, that's possible, that's not possible. Have you thought about this? And then we come together. So when we've got a concrete deal, obviously, I recommend quite often that my clients come to you and then we work together and pull together and we have like I call it the triage of people. So you get it, because it's always really important to get that deal financed, because it's all very well coming up, because I can sit there and come up with some hugely creative stuff, but if you can't finance it, can't recycle your money, it's pie in the sky. So you could agree something with the person, but if you can't implement it, and one of the things I've learned from you over time is the fact that, it's got to be implementable. And there's sometimes something that, not everyone's commonly aware of that's going to stop that deal. So, for example, we've been talking recently with a client of mine that we were trying to buy a portfolio, but through a company, and we were talking about, share purchases and all this kind of stuff. And there was stuff in there that you could structure a deal, but potentially the banks wouldn't be happy, so couldn't therefore fund it. But that comes on to what is one of my favorite deals. And that was a deal, as I said, we worked on. And it was a portfolio purchase because the mentee of mine that I was working with came with a portfolio. It was a portfolio and he didn't have loads of money, cash. He had some cash, but not all of cash. And thinking about I can't remember all the figures because it was quite a while ago now, because we've been doing these types of deals for quite a while. But I think it was about 2.5 million or something like that. And therefore, if you think about it, with a 25% and stamp duty and all of that kind of stuff, you need close on £750,000 to complete such a deal.
And he only had £250,000.
I only had £250,000. But what we did was obviously identify that there was some other stuff in his portfolio. And what did you do with that?
I did a one remortgage just to get a little bit more money, just to grease the wheels.
And I think we also didn't we use a second charge? Didn't we also use we used a second charge to release some cash?
Yep. No, we actually use that second charge as like a cash pot.
That's right.
And so if you do have equity in your property, you can cross-collateralize that and have that as part of your cash as such. So he had
so it's not physical cash, is it? Like in the terms of cash in my bank, it's not physical cash. What it is kind of an offset mortgage where you can pull money out that goes into the deal and then goes back once you've processed it through the deal.
Yeah, and if you remember, he left that charge on the property.
That's right. To allow them to put it back, bring it out. It's kind of like imaginary money in a way, because it's never physical cash in your bank, but it's physical cash and goes to the solicitor back again and all of that kind of stuff. And so, obviously, there was a couple of other things that we did through that process was we started to pair up properties. So instead of like doing the whole transaction together, we split the transactions up. And also he had separate contracts on the different deals.
Which was the key, because when initially he came to you, he was looking at one contract for all 8 properties.
That's right.
And you said, hold your horses here. You haven't got enough cash for that. So let's do 8 separate contracts. And didn't he had the right, he could say when he wanted to complete.
Yeah, so it was all combined. I think it was exchanged. He took a while, and then he could complete when what needed to complete. And so what he did was obviously
BRR.
Yeah, he kind of then did BRR on Turbo, and he did 2 deals, recycled the cash through there, and then took that cash and put it into the next one. So sometimes, you leave a little bit of money in each time and you start to run out of money again. But that's where we're using the second charge to pull out money, put in money, and also he sold on to release more cash. So sometimes I think people go, I have to buy the lot. No, I can't do it. And it's like, no, there's nothing wrong with if you've got, 12, 13 properties and you sell 3 of them and you end up with 10. That's still not bad. But the other thing with the BRR is obviously he was moving up the portfolio from the 2.5 million that he agreed.
Yep.
High-end HMOs that he converted them from, like, the people who were on benefits in the properties, emptied them. They weren't in great condition. He created lovely HMOs, moved up the value, got them refinanced, got the money out. And I think the portfolio, from the top of my head, I think went from 2.5 to about 4 million, which obviously 4 million of borrowing is 75%. It's 3 million.
Yeah.
So he's recycled all this. So there would have been some investment. He released cash through that. So I think, didn't he end up with about 100,000 in his bank account? And also an award, which they were business partners, weren't they?
Yeah.
And they also won an award, which they got a free trip to New York or something.
Vegas. And you weren't invited.
I wasn't invited. You weren't invited.
I know.
And they were off into the sunset, and they were the heroes on it. But the brain power was both of us in this room today, I think, out of making sure it all happened. So I think that's one of my favorite deals. It's a system I've repeated. I've done myself in my very first year. I did a portfolio deal very, very similar. I did about 13 properties where I utilized that technique, recycling the money through in that fashion. And then there's different ways you can structure it. There's different ways you can work it through the system, but utilizing finance and doing that. And basically, I've been doing that ever since I first started investing. And then I've now helped other people. So that's why it was one of my favorite deals, because they got the trip to Vegas. And no, I wasn't jealous, and did it that way. So, brilliant deal, brilliant deal. And I think they've been living off it ever since. Certainly cash flowing very well for them. And I know they've been able to go on and do other things and bigger things. So so that's my favorite deal. What's your favorite deal?
Come on, Mike. I always mention it at the Cheese or Wine, don't I? Our commercial course we do. It's got to be your 21 bed Botner, or I think 24, sorry. It is that 24 lumpy HMO. And then anything over, I don't know, 12 beds, I call lumpy HMO.
And why particularly do you like that?
They're genius. It was genius because you exchanged, you took control of the property for 12 months? No, 9 months?
It was 11 months in total. I think I was after 18.
Yeah.
He didn't want it quite so long. Made it work. So I think we settled on about 11 months in the end.
Yeah.
Yeah.
You took over the management of the property. Yeah. You collected the rent.
That's right.
And then gave it back to him as part of the deposit.
I call it the property paying for itself. I also get other people to do that now.
Yeah.
The property paying for itself. And if you structure it in the right way, and it's a high cash flow property, so this lumpy HMO obviously had a low cash flow, we increase the cash flow out of it. So a couple of reasons why I wanted to take control of that was, one, so I could increase the rent.
Because it was 92 and you got out to 107,
something like that.
107.
Yeah.
And you had a valuation report, didn't you?
Yes, I also, that's right. I kind of understood what it would be worth. Through my network, I understood what it would be worth. I think someone else had a go at it, didn't necessarily work. And then I came back. I also knew that he was quite keen to sell. But yeah, so there was 2 reasons. I should come back to the 2 reasons. One was to be able to increase the rent, and we'll obviously come back to that. But also the other one was so I could collect the rent and then pay him in stages. So that created a deposit to actually, so when we came to finance it, but it was really important to increase the rents.
Why is that, Mike?
Yeah, well, I was going to ask you that, because obviously you know why that was, because obviously what we were trying to do was when we completed was I came to you, didn't I? I said, Bruce, if we've got a bigger than 6-month difference between exchange and completion, there's that kind of 6-month rule where properties aren't necessarily going to be worth what they're worth. And obviously I've done some work, though you stressed that, and done some stuff to the property, increase the rents. Can we complete on value rather than purchase price? So what did you have to do?
I then had to go and speak to the head of credit at Shawbrook Bank and put an overview together what we're actually looking to do here. There's X amount of work being done. You're looking to exchange. You're looking to manage the properties, right, for a period of time. And because you've been managing it and doing works to the property, can you complete on the open market value, not the purchase price?
Yes.
Because most lenders just lend off the purchase price, right, not the value.
Or certainly whatever the smaller is.
Yes, spot on. So, and then because there was such a long time between you exchanging and completing. I wanted to get it in writing. So I got it in writing from the head underwriter at Shawbrook Bank. So I had that piece of paper. So if you ever left, I could get it in writing, say, look, head underwriters agreed it. And what's happened is that Shawbrook now have adopted that as one of their lending policies. And there's lots of
Between us, we rewrote the policy.
we certainly did. And we had to get a line in the sand. I always talk about lines in the sand, don't I?
Yeah.
We had to get a valuation of the property as it was.
Yes.
And then we had to get a valuation post-works. I mean, you didn't do that much works to it.
No, but there was stuff I had to do.
There's stuff you had to do. I think roof work, because you were on the top of the roof at one point.
Yeah, you saw my Instagram and me in the hard hat above, on the roof.
I mean, there was also
Yeah, there was a lot of electric stuff that we had to do. This is also another lesson, actually, which I'll bring up at this point, is just because something has a license, and this had recently been through a licensing thing, and I think it was about a year later. Obviously, when you change ownership, so people always think, the license comes with the property. The license doesn't come with the property. The license is in your name, so it's your license. So when you buy an HMO, even if it's up and running, even if it has a license, you have to apply for another license, which comes into a whole host of things, doesn't it? We'll go through that maybe a bit in a while. But so you have to reapply for the license. And everyone automatically thinks, and they go, it's got a license, it will pass a license. Well, obviously, quite often it does. I always find, and my experience of this, is whenever anybody from the council steps into a property, they have to prove their worth, and they have to give you a list of things to be done. Even, almost it's the same person, and they could go back a month later and then give you a further list. And you go, well, you were here last. Why didn't you give me this list last time? Oh, I didn't notice it last time. Every time they'll notice something different. So, of course, what happened, and part of the process I had to go through with the electrics, was they come in and they go, oh, this needs changing, or this, you need this. And it's like, you gave this a license about 9 months ago, a year ago. And it's like, they're now asking me to do all this stuff. How come? Well, I didn't notice it. Always the thing is I didn't notice it.
And also policies always changing.
Yeah, that's right.
Yeah, it's always changing.
So be aware. So this is one thing, learning to take is always be aware. Be really, really vigilant on, just because it's got a license, won't necessarily pass first time. You might have to do some stuff, check it out, work out what it is. Obviously, you can't always get everything because, they always seem to spot something, but just work it out.
And local planning, local licensing laws and planning laws trump national. So always look on the local council's website, regarding license.
Yeah, because I get a lot of people who may say, well, what do I have to do? So always go and check your local council, the council that you're operating in, check their website, because there are some national standards, but very much local standards trump national standards. Well, national standards are the bare minimum, and quite often councils ask you to do a bit more. So anyway, we were going through that. We'd got to the exchange and completion, some works.
Yeah.
I'm trying to think where we were up on the thread of there. But
okay, so you fast forward. You're making all these payments.
Yeah,
you've got all that work done.
Yeah,
and I then get a second valuation.
That's right,
instructed.
Yeah.
So we went back to the same valuer.
Yeah.
Who gave us the yield, the gross yield?
Yep. So we can. So this is a secret. We'll come into this and the methodologies of how HMOs are financed. But the critical thing was having that yield in it, kind of stake in the. I always say putting that flag post in the sand. Now in that area roughly what your yield adjusted, what your yield is for that area in HMO.
Yeah, spot on. So you got the rent from 92 off the top of my head, up to 114, 100.
I think you said 107. Or it was something like, I can't quite remember the figures. I wanted to get it a bit higher.
We just couldn't get that.
Actually, all I find is the practicalities of implementing rent increases don't always sort of translate into theory sometimes, because sometimes people resist, and I don't know. It doesn't always. You always probably get a little bit less than you anticipate. My experience of that now.
Yeah, because it was a 10% yield off the top. That's gross off the top of my head. Yeah. So the initial valuation came in at 920.
Yeah.
The purchase price was $1 million, because he wanted $1 million.
Yeah, that's right. This magic number. So if I hit the magic number, I could buy the time.
Yeah. And then we got the value up to 107.
It was one point. I'm pretty sure that the valuation became 1.15, so it must be around 115.
Must be about 150.
And then we borrowed 75% of that. And then I did have to put some money in, I think, because part of the money then came from obviously the rent that was coming off the property. So it was, 70, 80 odd, 90 odd thousand that came out of that. And then obviously we then borrowed more. So that was another bit of the deposit. So if you think you've got to find 25%, and we had to also get stamp duty. So I did have to put some money in.
You did, but I think you ended up at like 90% loan to value.
Maybe a little bit more than that. Yeah. Not loan to value, loan to purchase.
Yeah, loan to purchase price, that was it.
So which meant I only had to find a little bit.
Yeah.
Because, and I think all in all, I needed about 50 grand to do that deal. And obviously it was a high cash flowing property because it was an HMO. Obviously there was other improvements over time that I was going to do as well. But there was some costs on the roof and stuff. But that was a good deal. And that, I think one of the things maybe why you like that is obviously that set precedent. It created so we were creating the policy in Shawbrook. Obviously, we worked with other lenders to do similarly.
Yeah, and it's now evolved and adapted.
Yeah,
which is great because we can now do this as policy, and it helps because I got a bridging firm now, so I'm now lending small pots of money out, and I'm registered with VAS
to your own clients,
to my own clients. Yes, existing clients of bonds, I know. And now because I'm on the VAS panel, I can now instruct VAS valuations, so you can get that line in the sand for that exchange. Last time we had to put in a bridging application, and then we had them put a long term buy-to-let app in.
Yep.
This time I can instruct the VAS myself.
Yeah.
And we can use the same valuer.
Yeah.
To come back doing to.
Yeah, because that's one of the key things, isn't it? Getting the right valuer to value at the right times and do the right things, and getting the choice as opposed to being forced upon you. That makes a big difference. Understanding how to present your property for valuations, understanding what to give the valuer, how to communicate to the valuer, all is important. And obviously all things that I work through with customers of mine so that we end up with the right valuation, because obviously one of the things I had was the spot on valuation track record when I was going a bit mad on the old HMO thing. So I wanted to also touch on like commercial valuations of HMOs. There's lots of myths out there. There's lots of people who go, oh, you can do this, you can do that. Now, again, it's changed a bit over time.
Yep, always does.
But I think, like, I just want to explain sort of some of the key principles, and then you could talk about maybe
dual account foods with different plannings, C3 to C4 and so. Yeah, just the audience.
That's right. So obviously, traditionally you've got C3 out. So a normal house is called C3. That is the planning class. For a residential use, C3. If you run a house as a buy-to-let, that's a C3. As soon as you have three or more people, and it's people, not bedrooms, three or more people who are independent of each other, not more than one household, three or more people of more than one household within a property, that becomes an HMO. That has to be a C4. Now, if you go 7 or more, that is a different planning class again, that is sui generis. Now, most properties can be taken from C3 to C4 under permitted development. So you could just buy a house, turn it into an HMO up to 6 bedrooms without going through any planning. Now, of course, local councils have all decided that they don't necessarily want loads of HMOs in their towns. So a huge number of them have implemented what is called Article 4 for HMOs, which takes away permitted development rights. There's Article 4s for, office to resi. There's Article 4s for all sorts of things, but this is around HMOs. So you can't automatically do it, so you have to apply for planning. The councils have instructed such strict regulations that it's very hard to get that planning permission. Some have known criteria, and if you know what that criteria is, you can go through the planning. So something that I did was got very good at understanding what I could turn from a C3 to a C4. Sometimes I'd make them bigger, and I'd go from the C4 to the SUIs. Wherever you are in the country, you need to apply planning permission. if you're turning the property into sewers, and if you're buying it, it should already have it or have some kind of permitted use or certificate of lawfulness or something like that.
That's it.
So always make sure that you've got the right planning when you're buying, because that has a huge knock-on and impact on finance. Does
Definitely. Without the correct planning, you're not going to get funding. You're not going to get funding.
And this is the one thing I think everyone doesn't always understand how important it is, do they? Because I think people just willy-nilly sort of, I can buy this or I could sell this, or, but a lender would always want show me clearly what this property is.
Yeah, and it's always about the usage. Okay, if it's being used as an HMO, it needs to have the correct planning if required.
And also, again, for everybody, planning is different to licensing, and people get confused.
Yeah.
So planning is about the use of the building. Licensing is about the local council's housing standards and making sure you have the right sizes, the right facilities, and all of this kind of stuff. And that is separate. And you get there's a different department in the council. They have different regulations.
And they don't speak to each other.
They don't speak to each other. Well, they do a little bit sometimes, because they'll go, will you get a license? We can only give you planning if you can get a license. Some councils are now doing that. So some do, but not very much. But you need to, so you might get planning, but not a license.
Yep.
But you should get a license if you meet the criteria. And again, check your local council's website for that. Now, once you've converted it, if you've had to get planning permission, this is when commercial finance kicks in, isn't it? So
Yes and no, because there's changes.
Well, there's changes. We'll come on to that. So let's explain kind of, I always think it's easier to start with this kind of like, if you have to go through some form of planning, which is the C3 to C4, and you've had to apply for planning, or someone else has already done that before you, that building can then be valued really essentially commercially, which will be therefore on the rent roll. You have to take off some costs, so it's called net adjusting, and different areas will command different yields, i.e. the return that you get out of that property dictating what the capital value is. That is the case, obviously, every area, sui generis, you have to go through planning, so every sui generis property will be commercially based. Just one thing to note is, obviously, if you're in a low yield place like London, that could be less than the actual bricks and mortar value, which is kind of the residential C3 value. But most other places, that is more, which is why a strategy outside of London, taking a house and turning it into a sui generis or a C4 with planning permission, but we'll come on to what else you can do. You can then commercially finance. And commercially finance means that, quite often you get good valuations and allows you to recycle your cash, and you can go again, which is why people love it and why people love HMOs. Now, as you were about to say, there's been a development in the marketplace, hasn't it? Just share with everybody what you're managing to achieve, because it's kind of got better for the investor.
Exactly. Now, for 2024, there's a new terminology in the HMO world, and that is overadapted.
Aha.
So
That's people do a lot of change, yeah. They?
yeah, so when you're taking a 4-bedroom house and turning it into a 6-bed, 6-en-suite, it can never be sold as a 4-bed house anymore.
Yeah, because if you've got en suites in the downstairs, what would have been reception rooms,
Yeah.
someone doesn't really want an ensuite in their lounge or an ensuite in their dining room. Do that. That's over-adapted.
That's over-adapted. And we can now, VAS, which are a panelled valuer, will allow me to instruct a long-form valuation on an over-adapted HMO now. So you're going to get a stronger valuation. One of my clients wanted to do a bit of an experiment. So we did a Paragon adaptation because it had free val.
Yeah.
And then we went to Quantum.
So that is that a non-VAS then? Or
That's non-VAS. So Paragon got
so what we're talking about is kind of like more bricks and mortar values
spot on.
versus more commercial values.
Correct.
And different lenders have different rules. And one of the things when we always used to do our cheese and wine commercial finance was explain the different lending criteria of different lenders, because different lenders value things in different ways. And you have to understand the valuation methodology of that lender to get the valuation that you want, which is when we come back to what I was saying. How I managed to get so many valuations right in a row is because I took the time working with you to understand what the criteria was. So sorry, I was interrupting.
That's right. So over-adapted, 6-bed HMO, Birmingham or Manchester, can't remember. I do remember the figures though. So we got a 320 in value with Paragon, and we got a 380 with Quantum because of the long form valuation. So that's an extra 20%. So that's
A huge difference.
and you can be, how much more money can you recycle out, and how much more time, and you can go again.
How much quicker you can then repeat the process because you're not waiting for all that cash to come in off the cash flow.
Correct.
You're taking the original investment and returning it, or if you've leveraged someone else's money, being able to pay them back quicker, or whatever, do all of that again. So you stretch your money, because one of the key things is stretching your money and making it go further. That's how you scale up your property investing.
Use the same money over and over and over again, just like your favourite deal with using those 8 properties. He only had £250,000 worth of cash, so that cash was used 4 times. And that's the key to building any portfolio, is recycling that cash. Get that uplifted value driven.
Making that cash stretch as long as possible. And we've talked about a few deals here that where you do that. One is recycling your cash through that classic BRI, renovate, refinance. We should probably put a P in there, planning as well.
Yeah.
Or over adapted. To be able to uplift the value. But we've also talked about structuring in terms of exchange and delayed completions. As another way of stretching that cash, but again, there's some stuff that is taking the property upwards.
It's just like Toby's deal.
That's right. So, obviously, again, client in common, where after we've changed the valuation or the underwriting methodology of Shawbrook, obviously, what that's allowed both of us to do is to repeat the process.
Exactly.
So obviously, client in common, now Property Investor of the Year, 2024, and done many deals. One of the deals that counted, Bruce, do you want to talk about the 2 blocks of flats that you did?
Yeah.
We used the same methodology. Yeah, we sort of walked through with him.
Retiring, these deals have got a common theme.
Yeah.
Retiring landlords.
Absolutely. My favourites, they know how to deal with.
Yeah. And they just want to move on. They want to just get rid of the property. They don't want the headache anymore. They probably bought it for 20,000, and now they're selling. And now they're selling for 500.
Yeah, I did listen to this. I was negotiating with one landlord, and he bought it off his father-in-law, this property, and it was a rundown HMO in Hammersmith. So sorry, I'm interluding, but talking about properties going up in value, I always think it's interesting. So his father had bought this property for £6,000. He bought it off his father-in-law for 60 grand. I was trying to buy it off him for 2.5 million. And I thought that was a deal. I think it was 2.5. I can't remember the figures, but it was several million. And he hadn't touched it for ages. I was actually going to turn it back. I think it was low 2s. I was going to turn it back, actually, talking about sui generis. So this was now a sui generis HMO.
You were going to go back.
I was going to go back
the opposite direction.
Opposite direction. Back into a nice stonking house in London, in Hammersmith, which would have probably been worth 3.5, 4 million.
Yeah.
So it was going back the other way. But he was like, I just want to retire and leave. I want some certainty. And he had, amazingly, he'd had some tenants who'd pretty much been there throughout his tenure, and some of them. So yeah. But anyway, that comes back to they've made their money. They're less fussed. Some are bothered about purchase price, but there's a lot of them who are like, I'm just ready to leave now.
I just want to get the deal done.
And they probably like gone beyond the point of wanting to exit. So they're now just like, that's the important thing. And they want certainty. One of the key things when I've spoken, I've done podcasts and chatted with Toby, it's always about certainty. And with me as well, certainty, exchange, certainty. And once they get that certainty, they relax a little bit because they know it's going to happen. And again, why? Both, Toby's deal, my deal, they're quite happy for you to take control because it's like, well, it's going to be yours now. I don't want the hassle.
Yeah.
You take it on now and just pay me the money and I'll see it coming in. You committed legally, which does have its risk. Don't get me wrong, it does have its risk. Everyone needs to be aware and, make sure they take legal advice, etc. It does have its risk. I'll hand it back to you now on the look, we're getting somewhere with this deal. Yeah, 2 blocks of flats.
It's 2 blocks of 4 flats.
That's right.
So 8 flats in total.
Yeah.
Once again, Toby went in there, got control of the situation, We got the valuation done. That's it. We got a valuation done. The first thing we did, just get a valuation done to what the state the property is currently. Okay. He then and we instructed NGDV's valuation. If he was going to spend X, what would the valuer think the end value would be? And we got all that information first. And then we looked at the figures. Was it a doable deal? Answer, yes. So then Toby exchanged. He took control, did 4 mini refurbs on each block. And then we got the same valuer back to value post-works value. Signed it off on the higher uplifted value. And he hadn't completed on the purchase. He already done his exchange and got control.
Yeah. And
then Shawbrook went on the finished value, the NGDV valuation. I think on both blocks he got 109% of purchase price.
Yeah, I think the average was 109, something like that. I mean, It's funny because he had two different values, I think, and one was better than
the other one, yeah.
Even though they were very similar buildings and all of this kind of stuff, but it just shows.
Yeah.
You can't always predict these things, but I think he went for that because he wanted to mitigate, because if they were both the bad one, it would be worse. And I think it was just in case he got sort of not quite the right valuation. So it's probably the right thing to do there. But he could complete on the actual value. And as you said, he got 109. There was he obviously had to invest some money into it to do the refurb. And obviously there's always stamp duties and all that kind of stuff as well. But
I think he only left 20 grand each
cash flows. And also he's got a high cash flowing strategy that he utilises. So that is the key thing there. So yeah, that's another great deal in creative finance that he does. So what do you, I mean, obviously you come across a lot of property investors because they go and talk to you, you arrange their finance, you tell me you're very busy at this point in time.
Yeah.
What would you mark up as the successful property investors, the ones that do really well? I mean, obviously you probably get some people who do the odd deal every now and again, maybe just refinancing, but the ones that are successful and build really good, solid portfolios, what would you say their traits are?
Well, they're planning, changing your use is a really good, easy way of increasing the value.
Because a valuer has a logical thing. You have to disregard what you pay for it because it was a different build. Well, probably might not be a totally different building, but it was like, it's a different, it has to be seen as something very different because the planning use has changed.
Correct. So a lot of office to resi.
Yeah.
Especially above shops. They've got shops, they've got some offices upstairs, convert those to C3. That seems to be working very well indeed. Clients chasing yields. So they're chasing money because they're after high yielding properties, over 15%. They seem to be doing well. And they're actually saying, okay, if I buy that property, I know you're asking for it to be that price, but it's got to be this price for me to get my yield, to allow me to buy this property. So I think it's the clients who actually get in touch and feel and kick the tires of the deal are the most successful ones, because they look at the angles, they change the planning, they change perhaps the tenant profile. All that helps to bring that money coming in. And we've had, high borrowing costs for the next last
years. Yeah, high borrowing costs because obviously interest rates have been at the highest level for since the credit crunch. But what people forget is that I started before the credit crunch in investing. It was high interest rates then.
Yeah,
and it's high interest rates now. So a lot of the principles back then apply now, and I think people have got so used to low interest rates. They're saying, "Oh, what's this? What's that?" It's like, well, this is the level you need to operate on. Things might get better, but if you operate at this level with these level of interest rates and have stress tested everything on this, then it's going to work. As you say, great yields. Focus on good yields. I think there's some good yields out there.
Yeah, definitely. Because yes, Bank of England's looking at Chatham Financial swap rates and the forward curves and something like that. The new norm is going to be 3.5%, 4%, according to these
ABR and Bank of England. Yeah, well, they won't tell you, will they? I do think it's going to come down. I mean, we were just chatting just before we went came onto the podcast, and you were saying I think it's going to be a very, very slow process coming down. Is that what you are saying for the next couple of years?
Yeah, Labour's government, Labour's budget has the market's thinking, Labour are going to overspend here.
So, I mean, Labour love to talk about stability, and there is some stability because we now know what it is. It's not hidden anymore. So that has given some stability. Trouble is, people are now realising that actually, rather than growth, which they talk about, there's the brakes on the economy through really these higher taxes, mainly the national insurance kind of thing that they're doing, which is going to break. I think, businesses are going to have to invest, pay for all these extra costs that they've got rather than investing and for growth. And that's a harsh thing to swallow, and it'll take a while to swallow. I think some businesses might go, we will lose some because of it. So it's going to shrink the economy a bit. Greener taxes are also something that's coming along, which I think again is going to take money out of the economy rather than put money in. But what you've got to recognise, and where I think the positivity is now we know what it is. I do think interest rates will come down. So it's heading in the right direction.
Yeah.
As interest rates go down, generally prices historically go up, so capital growth will be there. So our trend, the trend is your friend. So I think
chase the yields now and get the capital
chase the yields now. I think that's a really good way of looking at it. Chase the yields now, and capital growth will come, which will help with recycling. But if you've got some fantastic yields, and there's creative deals you can do, there's added value you can do, there's change of planning that you can do that helps you recycle the cash now. But the trend will be upwards, and the interest rates will come down. And again, I'm a big, for 2025, some of the areas I quite like, the mixed use buildings, those kind of things, big blocks of flats, buy off retiring landlords, which are kind of blocks. Again, stamp duty paying in they've added the 5%. But if you're operating in the more commercially zoned, which still includes blocks of 6 flats, residential, you can seriously reduce your stamp duty. You're not harmed by stamp duty quite as much, because to get some deals to stack now with that stamp duty is getting harder and harder.
Definitely.
I still have quite a few clients who are interested in just getting money. So what I would call capital projects, buy and refurb and sell.
Yeah.
And I think, again, by the time they're coming to sell, the market will be nice and I think relatively buoyant, depending on what they're doing and how long it all takes. So I think opportunities out there. Think about buy to sells. Think about the big blocks, bigger deals. I say go up a level, be a bit more out of the quagmire of competitiveness. Certainly the residential buyers are back in the market trying to get their stamp duty before the stamp duty change in April. So that market's going a bit mad. So stay out of that quagmire. Deal with the landlords who are retiring. Structure deals creatively to make your money go further. And I don't think you'll go too far. Rob, in 2025, what's your view?
Spot on, Mike. Spot on. We're aligned. So yeah, spot on. You gotta chase the yields, and then the capital will come.
And so, although people, I think, have got a little bit depressed about maybe the Labour government, the renters' rights bill, and everything, I think if you're seriously into this, there's always opportunities, and there'll always be people exiting. And I think more landlords are going to go because they're being squeezed and getting fed up. And you remember the days when it was all, it was always easier years ago. So, people do eventually go, oh, this is far too hard now. I've made a lot of money. Why do I have to continue this? And we'll exit. And they just want to get out now. And so, it's certainly an opportunity and time to go.
Cool. All right.
So,
thank you, Mike.
Thank you for coming in to have a chat today. Hopefully everyone's found that useful.
Yep.
Do get in contact if you, do get in touch with me through the socials, or Bruce through his socials. I think LinkedIn is probably a good way to get through to you. If you have a deal that needs financing, or you're thinking there might be a creative angle, get in touch and we'll see whether we can help you fulfill that deal and make 2025 your best year ever.
Sounds like a plan.